Hello everyone, this is Carbonomics. Since the start of the year, we've seen sentiment essentially fall off the cliff for carbon credit royalty companies. The combination of supply chain issues, rampant inflation, commodity prices skyrocketing, and a deteriorating global economy have not been positive factors for the stock market, as one could imagine. Carbon markets have been no exception to the broader market events here. Some carbon credit prices have held up surprisingly well, but for the most part, we've seen the end of the bullish cycle in prices, especially from what we've seen in 2021. With the rapid decline of investor interest in ESG names, both of the public carbon credit royalty companies' stock prices have essentially tanked this year. This video will focus on reviewing what has happened with both carbon streaming and base carbon, especially since the last videos I made on them 4 months ago, and I will link those in the description. Starting off with carbon streaming, which has had a more eventful experience over the past few months. Since I made my video in July, the stock is down about $1. Not great. Would I say the drop in price is justified? Well, it's getting harder to ignore the potential deal the stock offers right now. But the company is still facing some issues, which we'll get into. Even as they have continued to sign new royalty deals over this time. Carbon streaming's profile of royalty companies has increased to 21. With 10 or more of those expected to issue credits by the end of 2023. And here's how those carbon credit volumes are expected to break down over the next 5 years. We can see that NETS has signed more royalty agreements, meaning the company has further diversified its revenue sources. Something we definitely like to see compared to the company's earlier days. Now keep in mind, other credits that were set to be created in 2022 have been paid to carbon streaming quite yet, because they've been delayed. Specifically because initial volumes are mostly going to be coming from Rimba Raya, the company's flagship royalty project. Now, as you will know if you've been following the company, Rimba Raya, NETS' largest royalty stream, which is located in Indonesia, has been stalled due to the country needing to create a new carbon policy. Now, until they have completed that legislation, all credit issuances have seemingly stopped in the country. Now, well, in October, Indonesia's Ministry of Environment and Forestry have issued a new carbon framework. If it's good news or not remains to be seen. It's kind of difficult to find information on it. But the last update from the company was on September 26th in their year-end financial results, at which point carbon streaming withdrew all calendar and carbon credit delivery guidance for 2022. So we don't really know what's going on right now in Indonesia, unfortunately. And especially because it is difficult to gain access to Carbon Pulse. But going off of this headline alone, back in October, it doesn't seem like there's anything particularly good going on over there, at least for now. But we'll have to wait for further updates from the company to confirm that. It's also worth mentioning that the company has filed its registration form with the SEC to list on the NASDAQ, which could definitely bring some much needed liquidity and attention to the stock if they do manage to uplist there. So that's definitely something to keep track of. As a final note on carbon streaming before we talk about base carbon, let's discuss the management team for a second here, specifically compensation. Over the last 2 years, the executives of NETS have been paid in aggregate, $10 million in salary and share compensation. What did the management team do to deserve being paid $10 million exactly? The company's unprofitable. They don't even have revenues at the moment. They expected to have carbon credit sales in 2022. They didn't. Their flagship royalty stalled until the Indonesian government resolves its issues. That's a lot of money being paid out and potential dilution of the stock for essentially a total lack of results, besides some more royalty deals being signed here. To give you a comparison, the only other clear competitor to carbon streaming is base carbon at the moment, whose management team was paid around $500,000 in salary and $500,000 in share-based compensation over 3 quarters. Not too bad. Let's compare that to Carbon Streaming. As you can see here, the executives of Carbon Streaming were paid more than the executives of Base Carbon in 1 quarter, compared to Base Carbon executives being paid in 3. This is just in 1 quarter. This isn't even necessarily to say that I'm bearish on the stock, but the management team is definitely taking advantage of how much money they've raised, with help from people like Mary Cadusa. Quite frankly, I think it'd be pretty difficult for them to mess this up at these valuations, but this definitely does seem like some lifestyle company situations here. Now, hopefully revenues start in 2023. They still have around $70 million in cash with a market cap of around $77 million as I'm recording this video. So the company is essentially trading for cash, and that's all of its assets are being discounted by the market right now. It's trading at a 63% discount to net asset value. With stats like that, it's pretty difficult to see how they could mess it up. Like I'm saying. Now, could they? Of course they could. The stock is definitely attractive at these levels, in my opinion. And it's so cheap. My only real main reservation is the management team. So I still have to decide if investing in them is worth the risk, and I'm still undecided on that. Moving on to Base Carbon. The stock has essentially traded flat since my video in July, so there's not much to say on that front, really. The main news we had from the company was a press release that came out, not long ago, about a new letter of intent with the Danish Red Cross, specifically to develop blue carbon projects in Southeast Asia. The first project the group is working on will likely be a mangrove project in the Philippines, which is currently in the scoping phase. But Base Carbon will be coordinating with the Red Cross, over the next 2 years to do this, with the possibility of bringing in additional Red Cross members as well. So Base Carbon is certainly, developing some strong connections in these industries, and especially working with, large potential offsetters as well, which is great to see. Lastly, Base Carbon released their 3rd quarter financial results, with progress running smoothly so far on their 2 projects they have. The company still has around $25 million in cash, so not quite trading as closely to cash anymore like they were previously, or compared to Carbon Streaming. But on the bright side, Base Carbon is also starting to see, initial royalty streams, and they're expecting that in the first half of 2023. So revenues do seem to be on the horizon there. But in conclusion, both the stocks are incredibly cheap. Base Carbon is actually cheaper on a price to net asset value basis. And certainly don't take this as financial advice, of course, as always. With the times like these, when stocks are depressed, these tend to be the best times to start building positions in companies like this, especially when they're cashed up and they have no debt. So I'm looking to, at the very least, start buying into Base Carbon over the next few quarters here, and possibly buying into Carbon Streaming as well, if the stock stays this cheap. But this is all largely contingent, in my view, on the energy crisis taming down, the global economy coming back to some degree. So, we'll see what happens, and I'll keep you updated on that, especially on Twitter, so make sure to follow me over there. But yeah, well everyone, that's going to be the end of the video here. If you enjoyed it, please remember to like and comment, as well as subscribe to the channel. Thanks for watching.